It's really very unusual. Really, what is so unusual, Michelle, above many other things, is the resiliency that we see with the spot price. They will, like, for example, on Friday, if I'm not mistaken, it was Friday, they knocked it down hard, a couple of dollars, under 50 into the $49 range. And just like that, by Tuesday or Monday night, last night, it was at $53.30 spot price. Now, that would have been in Asia trading. And now they've knocked it down again today, trying to mitigate its rise. And today, right now, we are, where are we? We're right around 51.60 or so, climbing back up. The strength that it is exhibiting in the face of continued attacks on it, a huge backwardation, something I've never seen before, as much as a $3 spread between the spot market, the OTC market, and the December futures contract. This shows a massive stress in the system, unprecedented strain. To your point, it is unprecedented, and it's not just volatility, Michelle. It's kind of, to me, it's the market exposing the shortage of physical silver and the fragility of the paper promises. I think this is something that is far more than just a one-off. It's something I've never seen before. First of all, what it tells me is more than anything is that buyers aren't just rolling contracts over the way they used to. They're standing for delivery. They're demanding the real metal. And to me, the takeaway is that the rush for physical gold and silver is real, and it's intensifying. And markets just aren't trading paper contracts any longer. They want metal in hand. Now, this is multiplied by delivery strain. You and I have talked at length. Since November, we've seen a continual influx of metal coming into the COMEX market. And you can blame it on tariffs or blame it on arbitrage or blame it on whatever you want. I don't believe any of that. I think this is much deeper. There are people that want us to believe it's not as deep. Even the article that says that there are ships that are being loaded up to send silver over to London. I don't believe that at all. As a matter of fact, I think that's spin doctoring, kind of to buy some time for the LBMA. If silver was so plentiful, they wouldn't need a PR scheme to tell us about the silver that's heading over there. I don't believe it at all. But when you talk about exacerbating what's happening, we've already seen almost 17 million ounces of silver delivered into COMEX in the month of October. And when you see a London spot silver price at a $3 premium to the New York futures, a spread that hasn't been seen maybe ever, at least since the Hunt brothers in 1980, at a borrowing cost in London that has spiked to 100% annualized, worse than the 1980 panic, what this tells us is that the demand for physical silver at the highest level, we've about the central banks buying it. We've talked about China buying it and flying around the world and buying doré and concentrate. We've talked about Russia and their really massive acquisition of silver over the last 5-6 years. We've talked a lot about Saudi Arabia and their fund, who just bought a few $100 million worth of SLV. And that sucks in and of itself that it was SLV. But remember, at the level they paid or bought, they can stand for delivery. We've talked about Russia adding it to their strategic stockpile. And behold, we find the United States, the U.S. government, who wouldn't know a silver coin if it fell on their foot, it seemed all of these years, have now reclassified silver as a critical mineral. They have put a floor under the price of silver. So when you put all of this together and then add into it the most sophisticated traders on Wall Street, bringing metal in at the levels that they are, that is what is driving this. And in an environment where the LBMA, according to David Jensen, someone that you need to get on our show. David Jensen is amazing, and no one talks about the LBMA backdrop the way David does. And I think it's really very important we get him on. But what he's been saying lately is that there's 140 million ounce float of silver in London, meaning that's the amount of silver backing the contracts. The other silver they have there, the other 500 million or so ounces belong to the ETFs. So the only metal that is available, supposedly unencumbered, and who knows how much of it is unencumbered, when they already told us last year that they overstated those numbers by 100 million ounces at the LBMA. But if we take them at their face value, 140 million ounces, according to David Jensen, trading 600 million ounces a day in deliverable contracts, what could possibly go wrong? We have an environment where the exchanges and the paper promises are being usurped and passed on, even at large premiums. right now, where if you sent your metal, if you bought a contract on futures and sent it to London at a $3 spread, that's a big arbitrage. And there will be some players that do that. But I don't think the smart money, even at a $3 per ounce premium to send it to London, really wants to do that, because silver is becoming far more valuable than the currency that is used to buy it or to sell it. If the shorts can't deliver, Michelle, the paper game ends immediately and silver explodes higher. The day a short cannot deliver is the day that silver breaks free. No delivery, no trust. That's when silver goes vertical. And if COMEX or the LBMA fails to deliver, it's not a dip, it's a liftoff for silver. And the whole system is based upon promises to deliver. And if you can't deliver, it's the same thing as a force majeure or a default. And the whole system, which is systemically connected, the contagion that would come out of that would be extraordinary. And that is the $1,000,000 question, and where things get really bullish for silver. So yeah, could it happen? It's never been closer to, by all appearances, to happening, and more so in London than in the COMEX.
To that end, we've got reports that metal is being airshipped between vaults from the US to the UK just to plug the gaps. What does that tell you about where we are in the cycle here?
Yeah, I don't believe it. I mean, I think some of it is, yes. I think that there is some metal that is moving that way. But I think that that's more a PR campaign. I think that, yes, there's always going to be some commercial bank arbitrage that we're seeing right now, where they're able to, by sending it to London, capitalize on that spread. But I don't think that's really what is happening, to be honest with you. I think that is a PR campaign by Reuters and by Bloomberg to kind of say, hey, everything is okay. That metal, look, there is not a chance in hell that the metal can move over there fast enough to meet these demands. You're going to see lots of margin calls and unwinding of positions. And I think that it's just like they told us that silver was coming back here because of tariffs and arbitrage. I don't believe it. I think there is something much bigger at play here. And when the U.S. government reclassifies silver as a critical mineral, they're not going to be in a rush to send it over there to capitalize on some arbitrage. Yeah, you're talking millions of dollars. So what? I mean, I don't mean to say it in a cavalier manner that way, but I think the big noise about sending silver to London isn't strength. It's a cover story to calm nerves.
When you look at what's happening right now in the silver and gold markets, you realize something very unusual is underway. Not just another rally, not just another correction, it's a structural shift. Let me walk you through what I'm seeing, what you should watch, and why this might matter more than almost anything else you own. First, the spot price of silver has refused to stay down. We've seen drops, sharp ones, but almost as immediately the price climbs back. One moment it's under $50, then in Asia trading it rockets to over $53. That kind of rebound isn't typical. It signals tenacity, urgency, and serious demand. You don't get that from casual buying. You get that when buyers must have metal, not just want it. Second, the futures market is showing signs of stress. You'll hear about backwardation, a term many people haven't heard or don't understand fully. In a normal market, you expect contango. Futures prices higher than spot because storing, insuring, and financing the metal costs money. But now we're seeing the opposite. Spot is trading above futures. That means immediate delivery is more valuable than delivery later. That happens when the metal for now is scarce, or when people are rapidly shifting into physical ownership rather than waiting. Third, the lease rates, the cost to borrow actual metal to deliver or to cover a short, have exploded. In London, we've seen rates spike to percentages that used to be unheard of in normal silver markets. That's a smoking gun for shortage, for strain, for physical stress that paper markets can no longer absorb quietly. Fourth, global supply-demand fundamentals are shifting. Silver is both an industrial metal, solar panels, electronics, EVs, and a monetary metal. The industrial demand is surging while mining and supply are stagnant. The Silver Institute projects supply deficits. Cruxinvestor.com. When you combine that with a rush into physical metal, for monetary reasons, you get a double pressure environment. Fifth, trust in the paper promises that underpin futures and delivery contracts is weakening. Because when you begin to suspect that the promise may fail, either because the metal isn't there or because the chains are broken, you begin to demand metal in hand, not just a ledger entry. And the signs are clear. People are standing for delivery, not rolling contracts. They aren't speculating so much as securing. That's huge. Now let's parse why this matters and how you should think about it. When spot price doesn't behave like a normal market, when demand for immediate delivery outruns futures, when lease rates blow up and spreads widen, you are looking at the curtain being pulled back on the difference between paper metal and physical metal. And this is about as important as a crack in the floor in a building designed to be rigid, because the whole structure depends on faith and promises. Promises of delivery, promises of storage, promises of exchange. What you're seeing with silver is not just price rising, it's a reassignment of value. It's a phase wherein the metal itself becomes more important than the contract around it. And when that happens, the dynamics change. Liquidity vanishes, backwardation deepens, premium gets paid, arbitrage happens, and the market becomes less about traders and more about owners. Let me throw a question to you. If you believe that the next decade will be defined by currency debasement, accelerating inflation, debt problems, and the erosion of trust in the financial system, what metal should you own? The metal that represents money, not merely a commodity. Silver and gold are those metals. But silver in particular has the large upside when the system is under stress because it behaves both like an industrial metal and a monetary one. When the monetary role becomes dominant, its price can accelerate. We talk about gold a lot, and rightfully so, but silver may well be the lead metal in this cycle. Because when the system creaks, silver often cracks first, or at least moves faster. And the hints are there: backwardation, leasing stress, global flows, paper versus physical mismatch.
Are there really ever coincidences anymore at these levels? You know, the United States certainly is a very, very powerful, great country, but many of the nations whom are rallying against us using commodities as a sidestep to the dollar and the treasury market hegemony, they have a say in all this too. And to your point, the Shanghai Metals Exchange, as you and I have talked about on many occasions, is not only trying to gain credibility and have other countries store their metal with them. Remember, they're in the process of building multi-jurisdictional vaults all around the world, starting first in Hong Kong, now in Saudi Arabia, and then ultimately through the Belt Road. Now, China, the second largest producer of silver in the world, David Morgan will tell you when he went to China, they tried to tell him they were number one. So number one or number two, number gold, yet they're flying all around the country, buying all around the world, Latin America, Peru, and Mexico primarily, buying doré, which are crudely refined bars, and concentrate, the byproduct of the mining process, directly from these players, disintermediating the market, right from the miners, disintermediating the market, and sending it all the way back to China on their expense, paying double what the West will to refine it themselves. These metals are becoming very critical to them. So yeah, why wouldn't they want this to happen, to allow the price to go much higher? And how do they do that? The same way I've been saying this since the first interview you and I did together years ago. They're draining the exchanges slowly and methodically. They're standing for delivery in London. The London Metals Exchange has the lowest amount of silver, the float, they've ever had in the 140-year history of the exchange, at least since they started keeping records. And so they have been using the idiocy of the Western suppression system to beat us at our own game. The part that most analysts and most naysayers have a hard time justifying when we say this is that they haven't done it like that. Everyone in this country expects instant gratification, and if it's not fast enough, if it's not immediate, it ain't fast enough. That's their genius. Slowly enough to not rattle the bushes. But they've done a yeoman's job at that. Look at the countries involved. Saudi Arabia, China, yeah, they're all accumulating silver in their own way as fast as they can, but also gold, not too fast. And many of the other nations are too. So yes, this would indeed, and the mistake that we make in this country is thinking that we are omnipotent and we have the ability to control everything. And you know what? As I've said with you before, these countries are now sophisticated, coordinated, motivated, and they have a plan that is methodical, a plan that drives the analysts in the West nuts because it's not in your face, bang. No, but take a step back. It's just like the title of my show, little by little by little by little by little, and then bang, all at once. And we haven't seen the all at once moment, but is this the beginning of it? Maybe, could be, don't know. But absolutely, to your point, this would benefit not just China, but all of the BRICS nations. To say they have a hand in all of this and to poo poo it and say no way is as naive as a mud wall. It's absolutely, I think, very plausible that the Chinese have not only interest in seeing this, but are understanding that their actions and slowly exacerbating it ultimately is to their best interest.
Is there a way that China could physically help engineer the squeeze?
Yeah, by standing for delivery all around the world. And that's what they've been doing.
So here we are, standing at what feels like the edge of something enormous, something historic. The silver market isn't just showing signs of strain, it's screaming it. We're seeing moves and spreads that haven't been witnessed since the Hunt brothers tried to corner silver in 1980. Except this time it's not a handful of Texas oil billionaires. It's an entire global system wobbling under its own contradictions. You have to stop and ask yourself, how can silver be trading at a $3 backwardation, where the spot market is several dollars higher than the December futures price, without something being fundamentally broken? That's not just volatility. That's the market telegraphing panic. It's a neon sign flashing, physical shortage ahead, and that's exactly what this is. Not some temporary imbalance, but a symptom of a system that's losing credibility. Every time the price is smashed down, $2 here, $3 there, it springs right back up. It's like trying to push a beach ball underwater. That strength, that resiliency, tells you that the paper game is losing control. Normally, you'd expect a hit like that to shake out weak hands, but instead we're seeing the opposite. Stronger demand, tighter supply, and faster rebounds. People are no longer playing futures contracts. They're standing for delivery. They want the metal itself, not the paper promise. And why wouldn't they? When there's a $3 gap between the paper market in New York and the physical market in London, that's not normal. It's a warning. It's saying the paper claims vastly exceed the metal available. You can't have 600 million ounces of silver being traded daily in deliverable contracts when the float in London is only 140 million ounces. And that's the official number, which they've already admitted was overstated by 100 million last year. The math doesn't work. The system only functions as long as everyone believes that redemption is possible. But when confidence cracks, redemption becomes a run on the bank. Now, some people in the mainstream financial press are trying to explain it away. You'll hear stories about arbitrage, that traders are shipping metal from the US to London to take advantage of the spread. You'll see headlines saying the shortage is temporary. Don't believe it. Those narratives are public relations cover for panic. It's an attempt to calm markets, to buy time for the paper system to patch itself up before the next delivery demand hits. But time is running out, and metal can't move fast enough to fill those holes. Even if silver were being air freighted between vaults, it doesn't solve the fundamental problem. There simply isn't enough readily available silver to meet all these paper claims. The physical market has become the choke point. Think of it like this. For years, the financial world built a mountain of promises on a tiny base of real metal. Now, one by one, the promises are being called in. Every short that must deliver, every ETF that faces redemption, every contract holder who stands for metal tightens the noose a little more. Eventually, someone won't be able to deliver, and when that happens, the game ends instantly. The day a short cannot deliver is the day silver goes vertical. Not just a small rally. I'm talking about an earth-shattering repricing event, because the system is built on trust, and once that trust is gone, the leverage unwinds all at once. Paper silver evaporates into nothing, and only metal in hand remains real. No delivery, no market. That's why I keep saying, this isn't just another bull market in precious metals. It's the slow death of a paper illusion, and it's being accelerated by forces much larger than traders, central banks, sovereign nations, industrial users, and geopolitical shifts that have changed the balance of power in global commodities. Look at what China's been doing. They're not just buying silver bars on the open market. They're going straight to the source, the mines. They're flying into Latin America, into Peru and Mexico, buying door bars directly from producers. These are semi-refined silver and gold byproducts, and by purchasing them outright, China is cutting out the Western intermediaries. They're disintermediating the global metals market, building their own pipeline of supply that doesn't rely on London or New York, and then they're refining it themselves. That's not just commerce, that's strategy. China knows what's coming. They've been quietly building multi-jurisdictional vaults around the world, Hong Kong, Singapore, even Saudi Arabia, to secure storage independent of Western control. The message is clear. They're preparing for a world where commodities, not paper credit, define economic power. And it's not just China. Russia has been stacking silver for years, adding it to their strategic reserves alongside gold. Saudi Arabia just had its sovereign wealth fund buy hundreds of millions of dollars worth of SLV shares, the largest silver ETF. People might scoff and say, that's just paper silver. But at that scale, SLV shares can be converted to physical delivery. They didn't buy it for fun, they bought it because they can stand for metal. Meanwhile, the United States, the same government that once dumped silver on the market to suppress prices, has now reclassified silver as a critical mineral. Think about that for a second. After decades of ignoring it, Washington has quietly admitted that silver is essential to national security and industrial survival. When a metal becomes critical, it means they can't do without it. That reclassification alone puts a floor under the price. The government might not say it publicly, but it knows. If silver gets too scarce, it's a problem for everything from electronics to solar panels to defense. So what happens when the US government is buying to rebuild stockpiles? China is buying to diversify reserves, Russia is hoarding, Saudi Arabia is accumulating, and Western retail investors are draining the mints? You get a global tug-of-war for the last available ounces. You get panic buying by the smart money before the headlines catch up, and you can already see it unfolding. The premiums on physical coins are widening. Delivery times are stretching. Mints are backlogged. Even major dealers are whispering about delays. The pressure is building quietly, like a volcano before it erupts. Everyone pretends everything's fine, but you can feel the heat under the surface.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.